My name is Jake, welcome to the channel. In today's video, we're gonna talk about a 9% yielding pure play cover call ETF. And the ETF that we're gonna cover today is QDVO. This is an ETF from Amplify ETFs. I've had tons of you message me, via email in my comments on my videos asking what I think about this ETF. And because so many of you have asked about it, I decided to make an entire video on this ETF. Now, this is an ETF that I do not currently own, but after preparing for this video and the research that I've done, I'm actually really interested in the ETF. I think there's quite a few pros, there's a few cons to this ETF, and I'm going to discuss all of those in today's video. And as I mentioned at the beginning of the video, my name is Jake. If you're new to the channel, welcome. For those of you that may not know, I'm from Utah, and it's been a rough couple of days here, and I just want to say that I'm hopeful for the future, because without hope, there is no future. Be the good you want to see in the world, and that could look a little like this. So the ETF QDVO from Amplify ETFs is a little bit unique because it's different than most other ETFs out there, because most ETFs that you're going to find are really tied to an index, like whether it be QQQ from the NASDAQ, the S&P 500, and a lot of these ETFs out there, they track the index and they write calls on the QQQ, the underlying index as a whole. This ETF is quite different because it focuses on the index, QQQ, but they take a much more actively managed approach where they're actually owning the holdings from the NASDAQ, not one for one. They're selectively picking from the index and weighting them based off of their own methodology and their own approach. And they're writing cover calls selectively on the individual stocks that they hold in this index. And so this is very much a more active approach to a cover call strategy than you would see with like a JEPI or a JEPQ, or like the ETF that I covered a couple of weeks ago from Goldman Sachs, the GPIQ. This is more of a pure play cover call approach. And the way that I kind of think about it is, if you were to go to a portfolio manager or a financial advisor, and they would actually actively write cover calls on a handful of positions, and then send you the distributions, the income, it's kind of similar to that at a much lower fee and a more streamlined, simplified way. And so that's how you kind of want to think about this ETF compared to all the other cover call ETFs out there. This is a lot of people like the YieldMax ETFs. This ETF is very, very different, and I wouldn't even bucket this ETF in any other category. It's in its own category. It's more of a pure play. So let's walk through this together. So a couple of things. I'm going to highlight, some of the main points of this ETF, and I'm going to walk you through the ETF itself, some of the holdings, and share my thoughts and opinions on it. So first off, this is a monthly dividend ETF. So the ETF is going to be split between qualified and a non-qualified dividend. And we're going to touch on the tax implications later, but this ETF is going to pay you monthly. There are only 40 holdings. Now, the NASDAQ 100 holds 100 companies. This does not hold or own all 100 NASDAQ companies. They selectively pick which companies they're going to hold, and the expense ratio is 0.55%. This, in my opinion, this is a fair expense ratio. It is higher than, just holding a passive index fund, but what you're actually getting, they are writing the cover calls for you. So for what you're getting, I personally feel comfortable with the expense ratio. Now, if the expense ratio was like 0.75 or 1% or 1.5, I wouldn't even be covering it on my channel. That's way too high. I think that this is a reasonable expense ratio. So according to Amplify ETFs, why invest into this ETF? The focus here is on growth and income potential. The income potential and the growth potential is really where it's at, because the way that they're doing it, they're writing out of the money cover calls. So there is potential for capital appreciation. Other ETFs out there, like QYLD, for example, they're writing more at the money cover calls. So you're not going to, so therefore you're going to get higher distributions, higher premiums, but you're going to sacrifice the upside potential. So with this one, you're going to get the upside potential. The upside will be slightly limited, but less so than other ETFs. So that's very, very important to understand. So this is a cover call ETF that is focused on equities. So this is not to replace the other percentage in your portfolio that you would hold to equities. This is really more so if you're looking for income. Say you have a portfolio of SHD, DJRO. Let's say like 70, 80% of your portfolio is in those two ETFs. And if that's the case, I'll give you a big high five. If that's the case, maybe you're not getting the income that you need in retirement or for your goals, right? Because with SHD and DJRO, you're getting like a 3% yield, right? If you combine them together and, you take the weighted average. So by including an ETF like this, you're going to be able to boost your overall weighted average portfolio yield. So that's really the purpose behind this. And lastly here, this is very much an actively managed ETF. This is not passive. They are actively managing it. And that's why for me, considering what you're getting, professionals managing this for you, the expense ratio, in my opinion, is reasonable. And so when looking at the sector breakup, you're going to get overweight in technology. You're going to get some consumer communication services. It's probably Meta, for example, maybe, some consumer discretionary. I think that's Amazon for the most part. But so they're actively selecting 20 to 40 stocks, and they're actively and tactically, as they put it here, writing cover calls on it. And they are doing it tactically, which I will show you here in a moment. I'm going to go into the holdings and I'm going to actually show you which holdings they're actively writing calls against right now. And it's actually pretty interesting, but I'll take a look at that here in just a second. Now, if we go over here to Seeking Alpha and we take a look at the year-to-date chart here, this is with the dividend reinvested. You can do this by going under performance and select total return. So when we take a look at the performance of QDVO, for example, compared to the S&P 500, it's actually outperformed the S&P 500. If we look at the last year, this ETF has been around for about a year. It's outperformed the S&P 500. Now, when we compare this with QQQ, because the S&P 500 is good, it's the benchmark, but how does it compare to the NASDAQ itself? It's actually outperforming the NASDAQ on the year-to-date and since inception. So this ETF, though it's writing cover calls, it's actually outperforming the NASDAQ, and that has to do with how the fund is set up, how they're tactically, I like the word tactical, how they're actively selecting which stocks at what time, at what share price in the future they're going to write the calls on. I think this is a really interesting cover call, not just because the performance has been so great. That's kind of the check mark, right? All right, checks off that box. It's nice to have. And so it's good to see that the performance is holding up compared to and even beating the S&P 500, for example. And as I mentioned, this ETF is yielding right around 9%. And this ETF is fairly new. So, you'll have to track this and see this, how this does over time, as the market fluctuates with volatility, right? So these ETFs, a lot of it is tied to the VIX and how much premium is being generated based off of the fear in the market, right? Based off of volatility. And so a 9% is fairly, it's great, right? Compared to other traditional ETFs. It is lagging behind JEPQ and, these other cover call ETFs that track the NASDAQ. But I think you're trading that slightly lower distribution, that slightly lower yield for higher or greater total returns. And I think most people would probably, prefer that anyways. Most people, unless, they are maybe in their late 70s and all they really, really care about is income. They don't care about growth at all, like zero. So I think for the overwhelming majority of people, I think this is going to be a cover call ETF that would probably be pretty appealing because of the growth potential. Now, we've only seen this over the last year, so we don't want to, the jury is still out, obviously, with this. We don't know how it's going to perform in a flat or a bear market, but the biggest downside to cover call ETFs is in a bull market. And the NASDAQ has been in a bull market for the majority of this year. And so with a few bumps along the way, obviously, but it's done incredibly well. And so this is definitely an ETF that should be on your radar. It's definitely on my radar now that, there's a reason why people have been commenting on my videos to tell me to look at this. It's pretty good. So I got to hand it to all of you who have messaged me and wrote this in the comments for me to check this out. This is a good ETF. So I'm definitely intrigued by it. You can see here that NVIDIA and Apple and Microsoft, Google, Amazon, Broadcom, your traditional, Mag 7 are in here. And so you can see that it is still pretty top heavy with over, 11% in NVIDIA. This is very, very concentrated. And so what you'll notice towards the end of the video, what I'm going to say is some of the cons or what I dislike about this ETF is it is very, very concentrated. And so that's great in a bull market. In a bear market, that may not be so great. So it's just difficult to say and it's difficult to predict. This ETF is doing very, very well today. What if we were to have a recession, the AI trade were to go down? It's just, there's a lot of what ifs, right? And so this kind of scares me a little bit. I personally would have preferred them to limit the individual holdings, but if they would have limited it, they probably would have not outperformed the market. Because this is the market, right? NVIDIA, Microsoft, Apple, Google, Amazon, etc. So you'll notice here there's other names in here like Netflix, Visa. You even got the AMDs in here. You got Allstate. You got some insurance companies, Honeywell. You even got Procter and Gamble, a consumer staple, right? You got Oracle in here, right? You got a tobacco company with Altria. You got Coca-Cola. So a wide array of different companies. But what's really interesting and what I really like about this ETF is how transparent they are with the cover calls, right? If you look at other ETFs, you can see, I'll take GPIQ, for example, the ETF that I shared. They go in and they show you, what calls they have on the NASDAQ itself, but they don't show you really, that's about it, right? So they do it on the underlying index. With this is more of a pure play. This is as if you were doing this yourself. When you invest into an ETF like this, you don't really have to, if you don't want to, have, run cover calls on your portfolio because they are doing it for you, right? And so that's what I like about this is they're doing it for you. So they have covered calls, for example, selectively on Costco, on Oracle, Honeywell, Netflix, DoorDash, Allstate, Microsoft, AMD, NVIDIA, Robinhood, and this NDXP. This may be like I'm not exactly sure what this one is. This is probably like the index itself. Maybe somebody in the comments this is probably the NASDAQ itself as a whole, would be my assumption. But let me show you something really cool that I found here. So you got Oracle, right? So Oracle reported their earnings here this week and they just crushed it, right? They crushed it. The stock soared over 20%. Larry Ellison for a moment was the richest man in the world, right? So they wrote a cover call here over earnings, right? So they captured all of that volatility. They were able to generate a nice premium. They wrote it against 70 shares, so 70 or 7,000 shares, right? So you take 770 and you times it by 100 because each contract is 100. So how many shares do they have of Oracle here? Let me walk you through this really quick. So in Oracle, they got 12,507 shares. They did not write it against all 12,000 shares. So take, for example, if they wrote a cover call on all of their shares, then if Oracle were to blow past their strike price, they'd be forced to sell all of their shares. Okay, so this is what they mean by tactical there, and this is why there's upside potential. What if Oracle blows past their strike price, right? There's still upside potential, and that is what I like about the strategy of this ETF. And you can tell that these are professionals, right? They're not going to write it on all of the shares, right? So I really like that. So you can see that 7,000 of the 12,507 have calls against them. What is the strike price? They did a strike price of $335 for September 19th. So next Friday. So let's take a look and see where Oracle is at right now. Oracle is at $292. It spiked up above their strike price, but it has since fallen down. So if Oracle stays below that strike price of $335, the ETF collects all the premium and they don't have to sell their shares. They can then roll it and do more cover calls on all of their shares. They don't have to buy Oracle back at a higher price. So sometimes it works, sometimes it doesn't work. That's why, it's just the name of the game, right? But in this case, the cover calls from the fund managers here at Amplify ETFs, it looks like, I don't know, anything could happen in a week, right? But it looks like they made a profitable trade when it comes to the premium itself, if their goal was to not get assigned and sell the shares, right? But that's, who knows? Maybe they wanted to get assigned. But what it shows me is they picked a nice strike price, and it shows me that they know what they're doing. Or, they just got lucky. Who knows? Now let's go ahead and let's take a look at the some tax information that they share publicly on their website regarding the distributions, how they're taxed. So this is a piece that is very, very important, especially if you're holding it in a, not in a tax sheltered account. So just a, regular individual brokerage. So if we go ahead and we take a look at their annual report here for 2024, and we take a look and see how was the distribution taxed actually? How is it actually taxed? And so it's going to pull up this little, graph here. Let's see if we can zoom in a little bit. So you can see here that we're looking at this one right here, QDVO. And if we go over and we take a look at the distributions, you can see here for the month of December, the month of November, October, and September, and you can see the full year of these 4 months, the total amount of income that was paid per share. Okay, you can see that the actual income, you can see here. All right, so let's take a look at this. So ordinary income, this is generally how most cover call ETFs are taxed. This is a non-qualified dividend. This is not a qualified dividend. So you're getting a higher tax rate like your W-2 income, right? Ordinary income. And you can see here that a small percentage was also categorized as qualified income. So because they hold the shares of Microsoft, Apple, Altria Group, Procter & Gamble, etc., they're still getting the qualified dividends from those companies, and they're distributing those as qualified dividends. But here you can see the breakup of what is qualified and what is ordinary. And you can see that the overwhelming majority, obviously here in this case, is from the premiums are, non-qualified. What you'll notice over here is what is called a non-dividend distribution. This here is where you will find return of capital. So of the, 74.5 cents of dividends, or distributions, excuse me, about 8% of that was classified as return of capital. So you might be looking at this and thinking, okay, only a small percentage is classified as return of capital. Now, this is where it gets a little bit confusing, and I don't really like how they do this. I don't know if this is regulatory or what, but let's say, for example, you go and you click on this form, this 19A1 form, and you zoom in and you take a look at what they, disclose as the distribution is announced. And they say here that the estimated return of capital is 96%. And you might be thinking to yourself, wait a second. No, it wasn't. It was not at all. It was 0% return of capital. And so when you look at these disclosures, you might be scratching your head for good reason. This doesn't make any sense. Why do they disclose this and totally inadvertently, I'm assuming inadvertently, mislead investors when this was not return of capital at all? Now, this was the mistake of QYLD. QYLD did the exact same thing. All over their website, they announced, hey, all of our distributions, it's 99% return of capital. And then when everybody got their 1099 dividend form at the end of the year, they're like, wait a second, it was all ordinary income. I got to pay taxes on all of this. They were misled to believe that it was return of capital. So I don't like this. I don't know if this is, and I'm not smart enough to know if this is just regulatory and they're forced to do this, or if they have any influence over this, but this is very deceiving, and I don't like that. And I think that's something that they really, I hope that they answer to it somewhere else. They maybe shared it in a blog or posted it on their website somewhere. But as it stands, when looking at these, this looks incredibly misleading because, at the end of the year, this is for 2025. Is this really the case? Because it makes me believe, or question, can I trust this? And the answer is you probably can't trust this. And so that is something that's a huge red flag for me. And maybe somebody has dug deeper or saw this on another video that knows the answer to this. And maybe you can share it in the comments of this video. But I just don't know why this is the case. I'm sure it's regulatory that they have to disclose it. But why are they saying that it was all return of capital in the case of last year, for example, when it clearly wasn't? That's my only beef with this ETF, is this part right here. So that's the ETF in a nutshell. Now let's talk about what I really like about the ETF and what I dislike about the ETF. So the first thing that I really like about this ETF is this is a true pure play cover call ETF. I like the methodology because it's unique. It's unique because not a lot of ETFs do this, even though it's more of a traditional cover call approach. Okay, it doesn't just write calls against the NASDAQ or the QQQ, for example, like most cover call ETFs. It actually holds the shares and selectively writes cover calls on a portion of the holdings. And the word here is tactical. The fund managers have flexibility on individually selecting which stock, how many shares, and what expiration dates for the cover calls. So I really like this because they really have a lot of flexibility. They can take advantage of market trends. They can really focus on momentum, drive a lot of premium through this while still outperforming the underlying index, which I think is very, very impressive. But to throw an asterisk out there, hey, it's only been around for 1 year, so be a little bit cautious before dumping all of your money into it. Another thing that I really like is you're getting this ETF with a very reasonable expense ratio for what you're actually getting. So you would not get a lower expense ratio if you had a portfolio manager do this for you. So the expense is absolutely worth it, in my opinion, for what you're getting. There's nothing that I hate worse than overpaying for something that isn't of value. I definitely see the value here, and I would be perfectly comfortable paying this expense ratio of 0.55% for what you're getting. And if you follow my channel, you know that I don't say this lightly, so that hopefully, for those of you that follow the channel, that's saying something. So another thing that I really like is I like how it's focused on the NASDAQ versus more, dividend stocks with their other ETF, Devo. So they have a flagship ETF, Devo. It's been around really for years, almost over 9 years, I think. and it's done incredibly well. That ETF is more focused on, dividend stocks. So there's not as much premium to be had. There's going to be more of a qualified dividend there. You're going to have a lower dividend, but I really, I like the fact that they're also doing this on the NASDAQ, but they're also taking a very active approach to it where they're not including every single stock. And so I really am intrigued by it, and I like their approach. And another thing I really like is I like the issuer. I like Amplify ETFs. I feel comfortable owning one of their ETFs. Amplify ETFs was founded in 2016. They're not a startup. They've been around for a while. They've proven themselves to me from, I've heard about Devo for years. I've never invested into it, but I've done some research on it. I know these guys. I've seen them on CNBC. They're reputable. I really, trust is very important when it comes to, managing someone's money, especially in an active approach like this. And so trust is very important to me. I don't trust just anybody. You have to prove yourself to me before I'm going to throw my hard-earned money, okay, as something. So that's my personal opinion. But, though this ETF has not been around for more than a year, you can really take a look at the historical performance of their flagship ETF like Devo and see how they perform. You can see the historical, taxation of how the distributions were taxed. And so there's a little bit more history there. And so I'm much more willing to trust a newer ETF like this because of the issuer behind it. Now, looking at some of the things that I dislike with this ETF, I do tend to dislike the active management approach and the risks that come with this. Now, at heart, I'm more of a bogle, I guess, not a true bogle. I'm not a purist by any means, but I lean more towards passive investing, passive index investing. And this goes very much against that approach or that, investing approach. And so active management risk is very, very valid here, though they've done very, very well this year. They've managed it very well. This is an actively managed ETF, and the room for error is higher when comparing it to other passive indices. So that's really, really important to understand. And so that's something that I don't really like. It's not enough to completely sway me away from investing in it, but it's something that would definitely, I would definitely limit how much money I would invest into an ETF, for my portfolio relative to the other holdings. So this would only hold a smaller slice simply due to the active management risks that come with it. And another thing that I dislike about this ETF is I don't like how they publish their monthly disclosures on their 19A1 tax forms. When looking at 2024, the monthly tax filings were very misleading compared to the end year tax report. And so I just am not a big fan of that. It may be, regulatory that they have to do it that way, but it just seems very, very misleading. And I would love for them to, have like a link like, hey, this is, our tax filings, but check out how it actually was, right? Or, I just am kind of turned off by that. So I really don't like that. And so it's something that I would have to dig deeper into and spend more time understanding and learning more about it. And because it's such a new ETF, it's like, okay, well, maybe you just wait and see how this year goes with the return of capital. Or because it's such a similar approach with Devo, I could take a look and dive deeper into Devo and analyze it year over year. How much was return of capital versus ordinary versus qualified. Well, there you have it. There's a lot to like about this ETF, and I could see myself owning QDVO. I would even recommend this to my friends and family. My dad, he's looking to sell his house. When he's looking to reallocate that money from his house that he's looking to sell, this is definitely an ETF that I'm going to recommend that he take a look at because I think it fits right up his alley. My dad really likes higher distributions, higher income, but he still wants that growth potential. And seeing the fact that this ETF has outperformed the NASDAQ, this year is just absolutely incredible. Obviously, past performance is never a guarantee of future performance, but it is absolutely impressive and it catches my attention. This is something that, maybe I allocate a percentage of, of some of this to my wife's portfolio as an example. So this is something that I would recommend to my friends and family. I consider you all my friends. So if you're, looking to invest into this ETF, you have my full blessing to invest into this ETF, my full support and endorsement. I like the ETF. Because this is a dislike and like list, I'm not going to talk about all the downsides or upsides of covered call ETFs in general. I've touched on that topic a lot these last couple of weeks and in general. But if you do not know the upsides and downsides of covered call ETFs, I would suggest watching the video that pops up at the end of this video next to learn more about that. But yeah, thank you so much for watching, everybody. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.